Hello everyone, it's Steve Williams with the creditrepairshop.com bringing you another video, and in today's video we're going to talk about credit cards. Yes, those credit cards that are in your wallets right now. I'm not talking about debit cards. I'm talking about credit cards that you have that are unsecured, where you've actually gotten approved, and these are ones that are not attached to your checking account. Now, we get a lot of this is probably one of the number one things that affects individual credit scores, because credit card companies have things that are written into the laws to benefit them in ways that other loan companies can't. Basically, because a credit card is a revolving line of credit, they can constantly change the terms of that credit card month to month. It can go up or down or whatever. They can do whatever they want to do, and there's basically nothing that you and I can do about it, because it's an unsecured line of credit, and because it's not a contract that is like a car loan or a mortgage where you borrowed a certain amount of money and you're just paying that money back over time. Credit cards go up and down each month. You could get charge $1,000 one month, pay it off, and pay pay no interest and just pay a finance charge, or you could pay payments over time to pay that off, and you'll pay interest and a finance charge each month. But basically, the balances, the number one problem that I see with people with those balances is that if you charge anything over 35 to 40% of your available credit, it's going to hurt you on your credit reports. And a lot of people don't understand that. They'll even think that, okay, if I have a credit card and I have a $5,000 balance and I charge $5,000 and I pay that $5,000 off, you could still be penalized even though you're paying that balance off, because you're utilizing all of the available credit that you had on that card. And what's going to happen is, whenever the bureaus are reporting for that month, when they're doing all the recording, and if they see that your balance is used all the way up on your credit card, you utilize all your credit on there, it's going to affect your credit report. Even though you're going to pay it off at the end of the month, when the payment is due, if the reporting happens before that, it's going to affect your credit score. So we tell people that from what we've seen from thousands of customers, is that you need to keep your balances and only charge 35 to 40% of the balance on your card. And if you're trying to build payment history, you need to go ahead and make the minimum payments, or pay a little bit more than the minimum payment, just to allow yourself to have a payment track record. Now, since the economic downturn in 2008, what the Congress had put a requirement for all credit card providers to do what's called real-time payoff reporting and data. Before, when people had credit cards, they didn't even know when they could pay them off. When you got the bill, you didn't even know a date that the card would be paid off. It just seemed like you were paying and paying and paying, and it was like it was never going to be paid off. So now, actually, if you open up your credit card statement, it'll tell you, if you pay this amount of the payment, the date that it would be paid off. And they actually had to make the payments match with a payoff period, because at first the minimum payments were so low, it was going to be impossible for the individual to pay off that credit card. But now they've increased the minimum payments on the cards to match with a date that it can be paid off, and that information has to be disclosed in your bill. And then when we talk about interest rates and interest rates increases, now with credit cards, depending on your credit and how good your credit is, But you could get some that as low as 11% all the way up to 28. And I've seen some as high as 32% on the balances. And a lot of people are like, wow, that's incredible. That's a lot of money to pay to borrow money. And something that a lot of people also don't know. Okay, now if you charge a card, you're no matter what, even if you pay it off, you're gonna have a finance charge when you pay that bill. But when you charge a card the regular way, the finance charges will not start until a 30-day period. But if you take cash advance, the finance charges will start from day one that you take that cash advance. Now, look at your contracts because companies are changing. These things change all the time. But basically, when you do a cash advance, you're going to start being charged finance charges right away and interest right away. And then when you're charging regular, you're going to be charged on a monthly basis when you do the cycle. Because if you pay it off, then you shouldn't be charging any interest, but there could be a finance charge attached to that. Rate increases. This is one that I cannot believe that Congress even allowed this one to be placed, that it's even legal to do this. But credit cards are the only company that can increase your interest rates based on what you do on another card. So say you have card number 1 and card number 2. Where you have your numbers there. And you are paying, let's say, 18% here. And let's just say 18% for both credit cards. And you fall behind on this card, on your payments, but you continue paying this one on time. You pay this one on time. These are two different companies. They have absolutely nothing to do with each other. Even though you pay this one on time, the laws state for credit card companies that they can look at the history on this card or what you're going through, and they can increase to whatever. I just put 25%, but they can increase your rate on this card because of what's going on with the other card. And I think that that's what happens with people is they get their credit card statement and they've gotten in trouble with one of their cards and they say, well, I'm just going to keep one good card. And then all of a sudden they're looking and the rates have increased on that card. Most of the time they think that because they had increased their balance on there, because they had charged a little bit more, that was the reason why. Actually, the reason could be simply because this card they stopped paying on, the other card, and this can happen for multiple cards. It doesn't matter. All of the cards can raise their interest rates because of what you did with this one card. They can base what they can change your interest rate to off of that. Read it in your contract. That's a little known fact that companies do not like to disclose, but they can do that. And when they do, and I think the reason why people it's basically because they increase their balances because they're having some financial difficulties and they just don't pay too much attention to what's going on with what the card is actually doing, how the terms are changing on there. And that goes back to when I said that the credit card companies, it's like a contract to pay back, but it's an open-ended contract on the terms. Now, I wanted to, before we close out the video, to talk a little bit about term life insurance. My company does not sell term life insurance, but it seems that when someone that I know that was close to us passes away, one of my former employees, he passed away. His name was John, and he had worked for me for, I believe, about 12 years, and he passed away from stomach cancer. And when I went to visit his wife and children at the funeral home, I had just noticed that, that they are struggling, that they're struggling to keep things going since he died. And it just makes me always think about, if you have a family, that you do need to have some type of term life insurance, something that you could leave for your family just in case something happens to you. Because if you're struggling, if you find yourself struggling in debt now and struggling to pay your bills, how do you think your family's going to get by if they don't have you? And term life insurance is one tool that you could use to at least have a safety net for your family if something happens to you, so they're just not left with everything that was there when you were here. They're not left with your struggles and the death, with losing you. So I hope this information was very valuable for you. My name is Stephen Williams with the Credit Repair Shop, and I'll see you in the next video. Thank you.